Well, hello everyone. We are looking at Consolidation of Financial Information, Chapter 2 of Fundamentals of Advanced Accounting. Learning Objective 4, we're describing the valuation principles of the acquisition method. We stated earlier that we're going to be using the acquisition method, which embraces the fair value in measuring the companies that we're purchasing assets and liabilities. So how does the acquisition method work? Basically, we are to identify the acquisition price, the consideration transferred. In later chapters, we're going to be introduced to non-controlling interest as if we own less than 100%. So we will also have to determine the fair value of the non-controlling interest. We need to identify any differences or in fair market value versus book value of assets and liabilities of the company that it's been acquired. And this may result in goodwill or a gain from a bargain purchase, which we'll be looking at later on. So we can define this into a little formula. We have our acquisition price, which we're going to compare with the net book value of the company that's been acquired. Again, net book value means assets minus liabilities, or stockholders' equity. And if we have a difference, we will try to allocate that to any under or overvalued assets and liabilities. If we still have a difference, then we will call this goodwill. Okay, so what exactly is fair value? So it will be the price received from selling an asset or paid for transferring a liability. So basically what someone else is willing to pay for your assets and liabilities if you were the company selling that business. Okay, so how much would a buyer be willing to pay for those assets and liabilities? So we can rely on three valuation techniques as defined in ASC 820-10-35-28. The first one is the market approach. So we could use, if you're selling your business and you're trying to determine the fair market value of that business, you can look at similar businesses that were sold recently in your area and see how they compare with your business and trying to assess their fair market value. Pretty much what maybe like a realtor will use in trying to assess the fair market value of a home, looking at comparable sales in that area in trying to assess that fair value. The income approach, on the other hand, we're looking at future cash flows. Okay, so we're going to project future cash flows for that business in the next 5 or 10 years. And then based on that, we are going to establish the fair market value, the worth of this company. We can also use the cost approach, basically looking at kind of like a replacement cost. If I were to replace this asset, so if this company has a building, how much would it cost to replace this building, to replace the equipment that we have? That will be the cost approach in establishing a valuation. Okay, so we talked about goodwill and gain on bargain purchases. So this will be the case when the consideration transfer, the acquisition price does not equal the fair value of net assets. So basically, if our acquisition price exceeds the fair value of net assets, we will have goodwill. So basically, we paid more than what the company was worth, maybe because we see future value in this company, therefore we're willing to pay more for it. So there will be goodwill associated with this consolidation, this combination. And if our acquisition price is less than the fair market value, then a gain would be recognized. And that concludes our presentation.